can learn from the masters. It is a necessary structure to survive the volatility of the 2020s. Financial influencers and market noise. The rise of financial influencers on TikTok and YouTube has democratized finance, but has also dangerously amplified market noise and misinformation. These influencers often champion specific stocks or coins, creating microbubbles and instant trends. Trend following provides a filtering mechanism for this noise. It teaches that your rules, your system, and the price action on the screen are the only opinions that matter. If an influencer drives a stock up 300%, creating a trend, the trend follower will enter. If that same influencer then causes a panic and the stock reverses, breaking the trend follower will exit. They are agnostic to the personality or the reasoning. They are simply reacting to the market's response, which is the ultimate barometer of all collective opinions. The essence of Koval's vision, rules over emotions. The cinematic scope of this book comes from its revolutionary stance on trading psychology. Most psychology books tell you how to control your fear and greed. Koval and the trend followers offer a simpler, more powerful solution. Eliminate the need for emotional control by replacing discretion with system. The trend follower uses a systematic approach that dictates when to enter, how much to buy, and most critically, when to exit. This system is their shield against the mental pitfalls of the market. When the price of your asset is plummeting, the human instinct is to hold on, to hope, to wait for a rebound. When a price is soaring, the human instinct is to sell too early, locking in a small profit out of fear it will vanish. These are the twin emotional failures that destroy most trading accounts. The trend follower doesn't use instinct. They use a rule, a line on a chart, a specific percentage. When the rule is broken, they execute the trade without feeling, without hesitation. This is the core genius of methodology. It turns a trader from a fragile emotional being into a disciplined, profit-maximizing machine. This audiobook will explore this methodology in detail, breaking down the specific rules of the greatest trend followers and showing how their seemingly archaic methods are perfectly adapted to capitalize on the hyperspeed, digital-driven markets of today. From the rise of ETF dominance to the addiction of leverage and the constant cycles of social media financial panic. The journey begins now, moving past the noise and deep into the simple, brutal truth of the markets. Price is all that matters. Chapter 1. The Lure of the Holy Grail. The journey into the mind of a successful trend follower begins with dismantling one of the most seductive illusions in all of finance, the myth of the Holy Grail. It is a dream that somewhere, hidden in a secret chart pattern, a proprietary algorithm, or the whispered insight of insiders, there exists one perfect, infallible method for making guaranteed profit in the markets. Every beginner looks for it. Many professionals secretly hope they have found it, and countless fortunes have been lost chasing it. The Holy Grail myth persists because it appeals to a deep psychological need, the human desire for certainty. We crave predictability. We crave control. We want the money to flow in smoothly, logically, and consistently. But the market is not a machine. It is a living organism, driven by the collective, emotional decisions of millions. To believe you can forecast its movement with perfect accuracy is not ambition. It is delusion, the predictor's paradox, comfort over truth. Most investors approach the market like a puzzle waiting to be solved. They analyze economic reports, decode Federal Reserve speeches, and scrutinize earnings guidance in hopes of unlocking future price movements. They seek comfort in predictions, because predictions, even when wrong, feel like control. This is the predictor's paradox. The more effort you put into predicting the market, the more emotionally trapped you become in defending your prediction. Once you say, Tesla will hit $500, or Bitcoin is going to $100,000, your ego is now tied to that forecast. When the price moves against you, you freeze, not because the data has changed, but because selling now would mean admitting you were wrong. The prediction becomes personal, and personal trading is fatal trading. This is why late-stage bubble participants always get destroyed. In the final moments of the 2017 and 2021 Bitcoin manias, people were no longer trading price. They were defending prophecy. They held not because the trend was intact, but because admitting defeat felt like betrayal. Their faith in the story blinded them to the truth staring back from the chart. A trend follower has no such attachment. They have no prophecy to defend. They follow the market, not their ego. Systems over secrets, the true revelation. Michael Koval reveals that the true masters of speculation, the great trend followers, have long abandoned the fantasy of the Holy Grail. Instead of searching for certainty, they built systems. A system is not a prediction. A system is a set of rules. Rules for when to enter, rules for how much to risk, and most critically, rules for when to get out. A good trend-following system accepts uncertainty. It welcomes randomness. It understands that most trades will be small losses. Its brilliance lies in its asymmetry. Small losses, unlimited gains. The trend follower is not trying to hit the lottery on one magical trade. Instead, they cast a wide net across markets, sectors, and time frames, knowing that only a few trades will become enormous winners. That's all they need. One massive trend can pay for dozens of small, controlled losses. Compare that to the retail trader who risks their entire account on a single options play, praying for a 100x return. They are grail hunting. The trend follower is harvesting probabilities. Price is the truth. Ego is the lie the Holy Grail myth survives because it is driven by ego, the irresistible need to be the smartest person in the room, the one who called it. But ego is the enemy of profit. Ego makes you hold losing trades. Ego makes you average down. Ego forces you to justify the unjustifiable. Trend followers avoid this trap by submitting completely to one principle. Price is the only truth, not forecasts, not fundamentals, not CNBC opinions, not chart patterns invented last Tuesday. If the price is trending up, the trend follower buys. If the trend reverses, the trend follower sells. No emotion, no argument, no shame. When Tesla began its meteoric rise, trend followers participated, not because they worshiped Elon Musk, but because price demanded their participation. And when the trend finally cracked, they exited, often long before the fundamental news confirmed the weakness. A prediction can deceive you. Price cannot. Why complexity fails? The graveyard of indicators. For decades, traders have tried to engineer the Holy Grail through complexity, building algorithms so intricate that even their creators barely understood them. But these models almost always fail because they rely on perfect conditions. The market is never perfect. It is messy, irrational, and constantly changing. Retail traders emulate this failure on a smaller scale. They mix RSI with MACD with Bollinger Bands, adjusting parameters endlessly, convinced that the right settings will reveal the secret. But all indicators are simply reflections of price. They add noise, not clarity. Trend followers embrace elegant simplicity. Identify the trend, quantify the risk, follow the rules. The market adapts to complexity. It cannot adapt to timeless simplicity. Modern investing reflection. The digital grail rush. In the age of meme stocks and crypto casinos, the Holy Grail myth is stronger than ever. Platforms like TikTok and Discord amplify the fantasy of instant riches. Meme stock enthusiasts seek the one trade that will change their lives. Crypto gamblers chase perpetual futures leverage, hoping for a 100x explosion. They are not trading trends. They are chasing miracles. A trend follower sees GameStop or Bitcoin differently. They see a trend. They participate with rules. And when the trend ends, they walk away, while the grail seekers stay behind, hoping the miracle returns. Most lose everything because they refuse to obey the simplest truth in trading. Nothing goes up forever. The first transformation, rejecting the myth, to become a true trend follower, is to abandon the fantasy of perfect prediction. It is to accept small losses with dignity. It is to replace ego with rules, emotion with discipline, storytelling with mathematics. The Holy Grail is not real. The system is. The moment you accept that success comes not from knowing the future, but from responding intelligently to the present, you take your first real step toward mastery. Trend following begins where the Holy Grail myth dies. And for the trader who embraces this shift, the market finally becomes what it truly is. Not a riddle to be solved, but a wave to be ridden. Chapter 2. Performance data and how it's generated. If Chapter 1 served to strip away the emotional comfort of prediction, Chapter 2 forces the aspiring trend follower to confront a far more uncomfortable truth. The performance data generated by systematic trend following often looks highly unconventional, even wrong, when compared to smooth, steady equity curves championed by traditional finance. This chapter is Michael Koval's vital instruction manual on how to properly interpret the results of a true trend-following system, a necessary education to prevent the trader from abandoning a profitable system out of sheer psychological distress. The financial world is dominated by the cult of the smooth equity curve. Wall Street analysts, fund managers, and robo-advisors all market themselves using charts that trend gently upward, minimizing volatility and suggesting an uninterrupted march toward wealth. This image is the second great illusion that Koval tackles. The actual performance data of a successful trend-following strategy is often jagged, erratic, and deeply challenging to human psyche. The anatomy of trend-following performance. Trend followers are not income generators. They are crisis hunters. Their system is designed to perform one task superlatively: capture the massive, multi-year, market-shaking moves that occur infrequently, the bubbles, the collapses, and sustained economic booms. This specialization leads to performance characteristics that violate every standard expectation of passive investing or value investing. 1. The low win rate reality. The single most difficult piece of data for a new trend follower to accept is the low win rate. Unlike a stock picker who might aim to be right on 60% or 70% of their trades, the trend-following masters often win on fewer than 40% of their trades, sometimes even closer to 30%. This is often the point where the emotional trader throws in the towel, convinced the system is broken. How can I make money if I'm wrong 7 out of 10 times? They ask. Koval explains that the win rate is irrelevant. It is a reward-to-risk ratio that matters. The system is predicated on the ruthless application of stop losses. On the 60% to 70% of losing trades, the system ensures that the loss is tiny, a paper cut. The trend follower enters a market, tests the water, and if the anticipated trend does not materialize, they exit quickly, preserving capital. The magic happens on the 30% to 40% of winning trades. Since the system has no take-profit target, these winners are allowed to run for weeks, months, or even years. These handful of trades, the ones that capture the entire 500% run of commodity or the 1,000% rise of an emerging market, must be large enough to not only erase the dozens of small losses, but also generate substantial net profit. In the world of trend following, 90% of your profit will likely come from 10% of your trades. This structure is a deliberate psychological weapon. By accepting and ritualizing small losses, the system shields a trader from the catastrophic losses that cripple most discretionary accounts. It means accepting that a long series of small losing trades is not a sign of failure, but rather the cost of doing business, the necessary search cost for the one gigantic winner. 2. The volatility and choppy periods. A second key characteristic of trend-following performance is the presence of long, frustrating periods of flat or even declining performance, known as drawdowns or choppy markets. Trend followers thrive when prices are moving definitively in one direction. They struggle when prices are oscillating wildly, trading sideways, or exhibiting no clear momentum. During these choppy periods, the system generates a relentless series of small losses. The price movement is just erratic enough to trigger the initial entry signal, but then reverses enough to trigger the stop loss, only to repeat the cycle. This is the whipsaw effect. The emotional pain of this is profound. The trader is disciplined, following the rules perfectly, yet their account is slowly being bled dry by small, continuous losses. This is the ultimate test of faith in the system. The traditional investor, seeing this data, would declare the strategy defunct. The disciplined trend follower, informed by Koval's work, understands this phase is necessary. The system is not failing. It is performing its job by patiently managing risk while waiting for the next crisis or boom. They know that the cost of sitting out these flat markets entirely is the risk of missing the explosive, sudden move that kicks off the next major trend. The performance data is teaching the trader patience and the necessity of enduring the uncomfortable search. 3. The skewness, fat tails, and exponential returns. The most distinguishing feature of trend-following returns is their positive skewness or fat tails. Traditional finance often assumes a normal distribution of returns, the bell curve, where extreme events are rare. Trend followers, by definition, seek out and capitalize on these extreme events. Normal distribution. Most returns are clustered around the average. Market crashes and parabolic rises are statistically improbable. Trend following distribution, characterized by a high concentration of small losses, the left side of the curve, and a very long high tail on the right side, representing the massive outlier profits. This is where the strategy earns its keep. When a market, be it the Nasdaq in 2000, crude oil in 2008, or Bitcoin in 2021, enters a state of manic, sustained movement, the trend follower is positioned to capture it exponentially. Their system forces them to compound their position size as the trend matures, maximizing the impact of the huge, infrequent moves. The performance data, therefore, is not linear. It is characterized by periods where the vast majority of the gains happen in short, dramatic bursts. A fund might be flat for 2 years and then, in 3 months, make a 60% return due to 1 or 2 captured trends. This is why a trend follower's equity curve looks like a staircase with long, flat treads and steep, vertical risers. The exact opposite of the smooth curve the market is trained to expect. The Great Deception, Benchmarks and Risk. Koval dedicates a significant part of this chapter to the inherent flaws in how the financial world measures performance, particularly the use of standard benchmarks like the S&P 500. The problem with correlation. Trend following typically trades a diverse portfolio of instruments, currencies, bonds, interest rates, metals, energy, and stock indices. The genius of this diversification is that these markets often have low correlation with one another. When the stock market is crashing, bonds might be soaring or the dollar might be weakening. This lack of correlation is the primary source of the strategy's long-term robustness. However, when comparing performance data to the S&P 500, a false narrative emerges. During a massive bull market for stocks, the trend follower might underperform the S&P 500 because their system is also generating small losses in non-trending markets like silver or the euro. The public, focused solely on stocks, judges a trend follower as losing or underperforming. Koval's argument is that the trend follower must be judged on their ability to generate non-correlated, absolute returns, not on their ability to beat a stock market benchmark. Their true value is revealed when the S&P 500 is crashing 30%. Because they short both stocks and commodities, they often generate massive returns during crises, proving their worth as a portfolio diversifier, a crucial lesson in the age of index funds dominating global wealth. Defining risk mathematically, Koval argues that the perception of trend following as risky or speculative is fundamentally misguided. In fact, it is one of the most mathematically rigorous and risk-defined strategies in finance. While the returns may be volatile, the risk is defined and contained by the system's rules. Stop-loss rule. Risk per trade is precisely known before the trade is entered. Position sizing rule. The system dictates the maximum capital, typically 1% to 2%, that can be lost on any single trade, ensuring that no single mistake can be catastrophic. Drawdown management. The rules often include a mechanism to reduce overall market exposure if the account suffers a significant predefined drawdown, e.g., 10% loss, essentially putting the brakes on when the system is struggling. Contrast the systematic risk management with the average retail investor engaged in leverage addiction or chasing meme stock manipulation. The emotional investor's risk is undefined. They only realize the risk after the loss has occurred, often leading to account destruction. The trend follower knows their maximum possible loss for the year before the year even begins, turning speculation into a controlled, probabilistic business. Modern context, the data gap between active and passive. The lessons of Koval's Chapter 2 are acutely relevant in a market dominated by the passive versus active investing debate and the rise of the FIRE-based asset allocation model. The core of the FIRE movement in passive investing relies on the assumption that a long-term dollar-cost averaging DCA approach into a diversified index fund will always be the most optimal path, primarily because active managers historically struggle to beat the index after fees. This is true for discretionary active managers, the forecasters, the stock pickers who rely on their intuition. However, Koval's data analysis presents trend following as an entirely different category. Systematic, non-correlated active management. The DCA/passive investor. Their performance data is smooth, but their largest drawdowns happen during major systemic crises, 2008-2020, precisely when the trend follower is often making the most profit by shorting markets. They ride every major downturn all the way to the bottom. The trend follower. Their data is choppy, characterized by drawdowns and whipsaws, but their system forces them to participate in the most explosive, sudden movements in all asset classes. They make money on the way down in a crash, providing the perfect countercyclical hedge to a passive stock portfolio. Koval's performance data, when viewed correctly, suggests that a portfolio containing both passive index funds and a disciplined trend-following allocation, even a small one, offers the best of both worlds. The long-term, low-cost growth of the market, combined with the crisis period protection and explosive upside of a systematic strategy. The data proves the point. The goal is not to have the smoothest equity curve, but a one that generates the highest risk-adjusted returns over a full economic cycle, including the catastrophic collapses. The trader's greatest enemy, Koval shows through the data, is not the market or the low win rate, but the inherent human desire to see a smooth, guaranteed progression. When the performance data inevitably turns choppy, the undisciplined trader will search for a new, smoother system, falling back into the trap of the Holy Grail and missing the massive trend that was just around the corner. Chapter 3. The Myth of the Financial Genius. One of the greatest obstacles preventing people from embracing a systematic approach is a seductive belief in the financial genius. The idea that extraordinary market success belongs only to a rare breed of gifted individuals with supernatural insight. This myth is everywhere today. It lives in the cult of the visionary tech CEO. It lives in the billionaire hedge fund manager portrayed as a modern oracle. It convinces ordinary investors that unless they possess elite IQ, elite education, or elite instincts, true wealth is beyond their reach. Koval dismantles this myth with precision. He argues that believing in the genius is not only false but dangerous, because it causes traders to imitate personality instead of process. The great performers of trend following succeeded not because they were brilliant forecasters, but because they submitted completely to a set of rules. Their power came from discipline, not divinity. The education illusion. We are conditioned to believe that financial success requires a pedigree, Ivy League degrees, Wall Street internships, advanced math. Yet the history of trend following proves the opposite. The famous turtle traders, recruited by Richard Dennis, were not economists or quants. They were ordinary people, a teacher, a security guard, even a science fiction writer. Dennis selected them precisely to show that a mechanical system, followed with discipline, outperforms intuition, experience, and raw intelligence. Trend following does not reward brilliance. It rewards temperament. The genius relies on prediction, complexity, and personal judgment. The trend follower relies on emotional detachment, mathematical consistency, and rule-based action. The true expertise lies not in knowing what the market will do next, but in knowing exactly what you will do when the market changes. Trading as a manufacturing process. Koval reframes trading as industrial engineering, not artistic creativity. A factory succeeds because the process is repeatable, not because a worker has a moment of inspiration. The trend follower operates the same way. 1. Input, price and volatility. 2. Process, a predefined system. 3. Output, profit, or a small, acceptable loss. There is no room for inspiration, no room for gut feeling, no room for a mythical genius who just knows. This analogy becomes even more powerful in the modern age of algorithmic trading. The world's top hedge funds were not through a lone genius making heroic decisions, but through systems that operate with ruthless mechanical precision. You don't need a supercomputer, but you do need the discipline to mimic one. The ego tax. The genius myth promotes the most destructive force in trading, discretion. Every time a trader overrides a system, out of fear, greed, or ego, they introduce chaos. This is what Koval calls the ego tax. The heavy cost of trying to be smarter than the rules. The ego tax makes winners tiny and losers enormous. It seduces a trader into holding losing positions and exiting winning ones. The trend follower avoids this trap by being willing to be wrong quickly. Their pride is in execution, not prediction. Confidence in the system, not the future. Trend followers do not claim certainty. Their confidence comes from the long-term statistical edge built into their rules. Drawdowns do not shake them, because drawdowns are part of the design. They trust the process, not the outcome of any single trade. And this is where Koval delivers the final blow to the genius myth. The true genius in markets is not the ability to predict, the ability to control risk. Trend followers put only 1 to 2% of their capital at risk per trade. They know their exit before they enter. They survive the storms that destroy the discretionary traders. The myth of the financial genius seduces the world. Trend following exposes it and replaces it with something far more powerful. A system anyone can follow, but few have the discipline to obey. Modern investing reflection, debunking the guru. In the 2020s, the myth of the financial genius has found its home on screens around the world. The financial TikTok and YouTube gurus often present themselves as possessing proprietary, secret systems, the modern holy grail. They flash expensive cars, claim impossible returns, and rely entirely on the viewer's psychological desire to believe in the shortcut. Koval's framework gives a listener the necessary armor to critically assess these figures. The guru sells discretion. They offer hot picks, specific trade targets, and subjective commentary, encouraging reliance on their personal judgment. The trend follower sell system. They offer mechanical rules, risk formulas, and statistical probabilities, encouraging reliance on a non-emotional process. The person who makes money in the market is not the one who follows the guru's specific stock pick, but the one who adopts the guru's claimed system, if it is even real, and executes it flawlessly. Since most gurus are selling personality, not process, the viewer is doomed. The ultimate lesson in Chapter 3 is that the successful trader is an executioner, not a prognosticator. The path to becoming a successful trend follower is not about becoming a genius. It's about becoming a machine, a systematic, unemotional executor of a positively expected set of rules. It is about understanding that true mastery is found not in brilliance, but in the relentless, mechanical repetition of the basics of risk control and trend identification. Chapter 4. The market is the ultimate truth. Having dismantled the myths of the Holy Grail and the financial genius, and having reframed success through the cold lens of performance data, Cole arrives at the most uncompromising law in the trend-following universe. The market is the ultimate truth. This is not a slogan. It is a worldview, one that demands a trader abandon ego, abandon prediction, abandon narrative, and bow before the only force in finance that never lies, price. This chapter is where the philosophical weight of trend following finally crystallizes. If every opinion, forecast, economic model, and expert analysis can be wrong, and history shows they often are, then the rational trader must align their decision-making with the one thing that reflects the collective behavior of every market participant, the current price. The tyranny of the narrative. Humans are addicted to explanations. We want to know why a stock rose or fell. We want to believe that news stories, analyst reports, and CEO interviews offer actionable insight. Narratives soothe the mind. They give chaos a structure. But Koval argues that these narratives are traps. The moment you attach your beliefs to a story, you become biased. You begin to ignore data that contradicts your story. You hesitate when you should act. You hold when you should exit. And by the time a narrative becomes widely understood, it is already priced in, its profit potential already gone. The trend follower liberates themselves from this tyranny. They do not need to understand why Tesla is rising or why gold is breaking out. They only need to see that it is rising, because the price incorporates every piece of relevant information faster than any trader or analyst could hope to interpret. Narratives comfort the ego. Price reveals the truth, the infallibility of the collective. The market price at any moment represents the combined decisions of millions. AI trading systems, sovereign wealth funds, hedge funds, swing traders, and small retail accounts. This collective decision-making process, no matter how irrational it may look, is far more powerful and far more informed than any individual analysis. Thus, when price contradicts your thesis, the trend follower has only one conclusion: the market is not wrong. You are. This humility is lethal to ego-driven traders, but essential to long-term survival. A value investor might wait years for the market to correct to their viewpoint. A trend follower simply adapts to what is, not what should be. The trend follower philosophy is rooted entirely in the present, and in the present, the market's current price is absolute truth. The 4 pillars of market truth. Koval reduces his philosophy into 4 practical pillars. 1. Price is king, the signal. The trend follower ignores forecasts, fundamentals, and media chatter. They observe only the price trend. Is it rising? Then they're long. Is it falling? Then they are short. Everything else is noise. 2. Risk must be defined, the survival rule. Since the market is always right, the trader must admit quickly when they are wrong. The tool, a stop-loss set before entering the trade. Once hit, there is no debate, no emotion. The market has spoken. 3. Trends exist, the opportunity. Market history proves that human fear and greed create sustained price movements. Trends that last weeks, months, even years. These trends are the source of the outsized gains that define trend following. You don't predict them. You detect them. For execution is everything, the discipline. Even the best system fails without perfect execution. When price at your entry, you enter. When price at your exit, you exit. Instantly, mechanically, without drama. Execution is the bridge between truth and profit. The ETF dominance paradox. The rise of passive investing illustrates Koval's point. Millions of investors funnel money into index funds without any analysis, creating a powerful upward trend in major indices like the S&P 500. A trend follower sees the truth in the price, sustained upward pressure. They ride it until the trend breaks. Similarly, in crypto, price, not white papers, not technology, not community narratives, tells the truth. When Bitcoin runs, everything around it moves. When it collapses, the trend follower exits mechanically, while the hopeful believer clings to a dying narrative. Modern investing reflection. Social media panic cycles. Today's trader is bombarded with financial noise, bank failure rumors, political drama, inflation scares. The retail trader reacts emotionally. The trend follower reacts only to price. If panic breaks a trend, the trend follower exits or goes short. If panic doesn't break the trend follower ignores the headlines. Price, not panic, dictates action. The final lesson. Koval's message is stark and liberating. The market is a force of nature. It does not care about your beliefs, your intelligence, or your feelings. It only reveals the truth through price. The trader who aligns with that truth survives. The trader who fights it is destroyed. Trend following is not about being right. It is about obeying the only truth that matters. Chapter 5. Why Fundamentals Don't Work. The most heretical chapter for any investor steeped in traditional finance is Koval's relentless assault on fundamental analysis. This core belief system, which dominates business schools and financial media, dictates that the true value of an asset can be determined by analyzing its underlying financials, earnings, balance sheets, cash flow, and market share. Chapter 5 argues, with the backing of historical performance data, that while fundamentals may tell you the value of a company, they are functionally useless for predicting the price movement of its stock in the short to medium term, which is the entire domain of speculation. For the trend follower, believing in fundamentals is just another, more sophisticated attempt to find the Holy Grail. It is a search for inherent, objective truth that the market ignores until it is too late. The system of trend following must operate on the principle that price precedes fundamentals, and the market can remain irrational longer than you can remain solvent. The lagging indicator trap. The primary structural flaw of fundamental analysis is that it is, by its very nature, a lagging indicator. Financial reports, quarterly earnings, annual statements, and regulatory filings are historical records. They tell you what has already happened. By the time a company announces spectacular earnings that fundamentally justify a higher stock price, the smart money, the large institutions, and the algorithmic programs that process information faster than any human have already anticipated, traded, and moved the price. The traditional investor, reading the news of a phenomenal quarter, buys the stock, thinking they are acting on truth. They are often buying the stock from the systematic traders who are already exiting their long position because the explosive price move is showing signs of slowing or reversing. The trend is breaking. regardless of the excellent financial results. Koval points out that the market is a discounting mechanism. It is constantly pricing in the expected future fundamentals. The price of a stock like Tesla in its high-flying phase was never a reflection of its current earnings or production capacity. It was a reflection of the market's collective, euphoric belief in its future dominance and potential growth. An investor using traditional fundamental metrics would have dismissed Tesla as wildly overvalued years before its biggest gains, missing the entire trend because they were anchored to historical, published truth rather than the speculative, forward-looking truth of the market price. The problem of definition and interpretation. Fundamental analysis relies on the ability of an analyst to define and interpret true value. But what is true value? Is it based on price to earnings, discounted cash flow, or a subjective assessment of management quality? The sheer complexity and subjective nature of these metrics make them unreliable in a probabilistic trading framework. Different analysts, using the exact same data, can arrive at wildly different conclusions about a company's intrinsic worth. One can argue a company is undervalued at $50 based on future growth, while another argues it is overvalued at $50 based on industry comparison. The trend follower bypasses this intellectual ambiguity entirely. They do not care what the intrinsic value is. They only care the collective market is bidding the price higher or lower. Furthermore, fundamental data is incredibly vulnerable to external, non-quantifiable shocks. A company with a pristine balance sheet can be instantly shattered by a geopolitical conflict, a natural disaster, or a sudden regulatory change. Events that are impossible to model in a fundamental valuation. The social media financial panic cycles can wipe out a fundamental thesis in a day, purely through emotional selling. Since the fundamentalist is anchored to their valuation, they hold through the crash, believing the price will eventually return to the value, often enduring crippling drawdowns. The trend follower, anchored only to their systematic stop-loss, is out of position, having listened to the market's immediate, catastrophic truth. Trends are driven by emotion, not spreadsheets. The most powerful trends, the ones that generate exponential returns, are rarely driven by subtle shifts in EBITDA or a 1% increase in market share. They are driven by massive, persistent human emotion, greed and euphoria. These drive parabolic uptrends. Whether the Bitcoin bubble, a high-growth tech stock, or a commodity like crude oil, the price runs far above any rational fundamental valuation because the collective hope and FOMO are so powerful. Fear and panic. These drive devastating downtrends, often turning solid, fundamentally sound companies into temporary pariahs as systemic fear forces liquidation. Trend followers are purely concerned with capturing the energy of this collective human emotion. Fundamentals are the skeleton of the company. Emotion is the muscle and blood that moves the price. Trying to trade based on fundamentals is like trying to drive a car by analyzing the weight of the engine block. It is a static analysis of a dynamic situation. The true lesson is that price is the immediate manifestation of the market's collective emotion, and that emotion is what creates and sustains trends. Koval teaches that a system designed to follow emotion, price, will always be more responsive and profitable than a system designed to follow history, fundamentals. The inefficiency of fractional shares culture and low barriers. The modern era, with its zero-commission trading and fractional shares culture, has paradoxically made the market more susceptible to emotional trends and less rational in the short term. When millions of retail investors can easily buy tiny pieces of any stock, market movements are no longer dominated solely by sophisticated, fundamentally driven institutions. They are increasingly driven by collective sentiment, social media coordination, and the desire for quick gains. This means that a stock can trend purely because it has momentum and hype, completely divorced from its core business. The price is dictated by the velocity of cash inflows, not discounted cash flow. This environment is toxic for the fundamentalist, whose careful calculations are overridden by a wave of emotional buying. It is the perfect hunting ground for the trend follower, whose system is designed to identify and exploit this momentum. The fundamentalist sees the meme stock manipulation of 2021 as a market failure, a temporary anomaly that will eventually correct to its true value. They often short the stock early, betting on the return to fundamental reason, and are financially destroyed by the irrational momentum. The trend follower sees it as a powerful, albeit short-lived, upward trend driven by immense retail interest, a trend to be followed until price action confirms its end. The difference is humility. The trend follower accepts the market irrationality as a profit source. The fundamentalist fights it. The systematic advantage. Diversification across the board. A final, practical reason Coble dismisses the use of fundamental analysis in a systematic trading strategy is the sheer impossibility of applying across the vast, global universe of assets necessary for proper diversification. A trend-following system must trade dozens of uncorrelated markets to minimize risk exposure to any single economic or sector-specific event. This includes commodities like cocoa, agricultural futures, government bonds in various countries, currency pairs, and global stock indices. It is utterly impossible for one person or even a large team to develop genuine fundamental expertise and conviction on the supply/demand curves of every single market they might trade. The trend follower does not need to know the fundamental outlook for the Brazilian real versus the Japanese yen. They only need a consistent mechanical rule that tells them that the real is trending higher against the yen. The price is the only common language across all these disparate markets. By focusing solely on price, the trend follower is able to diversify their capital globally and systematically, maximizing the chance of catching a massive trend somewhere in the world at any given time, regardless of the underlying reason. This diversification is a true structural advantage over any strategy anchored to the limited universe of fundamentally analyzed assets. Modern investing reflection, passive versus active, and the ETF trap. The lessons of Chapter 5 clarify the relationship between active and passive strategies in the current landscape of ETF dominance. The rise of index funds is often presented as the ultimate victory for fundamental analysis, investing in a basket of quality companies and letting the long-term value creation play out. While this is a brilliant long-term wealth strategy, it creates a massive fundamental vulnerability for the global market. Correlated risk. Because everyone is buying the same basket, a systemic fundamental shock, like a global recession, causes all these fundamentally sound companies to fall simultaneously. A pure fundamentalist who is long only in a diversified stock portfolio has defined their long-term thesis. Fundamentals will win, but they have neglected their risk definition, how to avoid the 40% crash. Coble's trend follower provides a necessary structural hedge. The trend follower is directionally agnostic. When the fundamentals collapse and the market begins its systematic downward trend signaled by price, the trend follower can go short, profiting from the collective panic. This ability to make money in a crisis is only possible because they ignore the fundamental narrative that the market must eventually bounce back and simply follow the price truth, turning systemic failure into exponential profit. The conclusion is not that fundamentals are wrong, but that they are irrelevant to the task of systematic speculation. Fundamentals are a tool for valuation. Price is a tool for timing. The most successful trend followers choose to focus on the immediate, observable truth of the price, accepting that the world is too complex and human emotion too powerful for any spreadsheet to accurately predict the trajectory of wealth. Chapter 6. The Strategy. We have spent 5 chapters clearing the mental deck, sweeping away the myths of the Holy Grail, the financial genius, and the reliance on lagging fundamentals. We have accepted the uncomfortable truths that the market is always right and that performance is often volatile. Now, Coble provides the blueprint, the cold, hard architecture of the system itself. This chapter is a shift from philosophy to execution, from why to how. It details the 5 indispensable components that, when executed flawlessly, transform a human trader from an emotional spectator into a systematic, profit-extracting machine. The success of the trend masters, the Turtles, Ed Sequoia, John W. Henry, was not rooted in a proprietary algorithm that predicted the future, but in the disciplined, unflinching execution of 5 simple, mechanical decisions. Coble refers to this as the 4 decisions, with a necessary 5th expansion, which together form the complete, systematic strategy that eliminates discretion. Decision 1. The universe, what to buy or sell. The first decision in a trend-following system is seemingly the simplest, but it underpins the entire risk management structure. What markets will I trade? A discretionary trader typically restricts themselves to 1 or 2 markets, stocks perhaps, or a specific sector. This specialization is often considered a sign of expertise in traditional finance, but in the world of systematic trend following, it is a fatal vulnerability. Specialization creates correlation risk. If your entire portfolio is in tech stocks and the tech sector crashes, your entire portfolio crashes. The trend follower's universe is vast, global, and diverse. It must include all major liquid asset classes, stocks indices, S&P 500, FTSE, Nikkei, etc., to capture equity trends. Commodities, gold, crude oil, corn, sugar, metals, to capture supply/demand and global inflation waves. Currencies, major and minor pairs, to capture global monetary trends. Bonds/interest rates. Treasury futures, to capture macroeconomic trends and interest rate shifts. The sheer breadth of this diversification is the system's protective shield. Koval highlights that the goal is not to find a trend. The goal is to be positioned to catch a trend wherever and whenever it emerges globally. A true trend follower doesn't care if the U.S. stock market is flat. They only care that something is trending. Perhaps it's the price of natural gas or the relative strength of the Japanese yen. This decision is more crucial than ever in the age of ETF dominance. While index funds are praised for diversification within equities, they ultimately tie the investor to the fate of the equity market. The systematic trend follower, by trading global bonds, currencies, and commodities, provides the necessary non-correlated returns that keep the portfolio stable during equity crises. When the S&P 500 is in a devastating multi-month decline, the bond market might be soaring or crude oil futures might be crashing, both generating massive, profitable trends for the systematic manager. The universe election ensures the system is always fishing the right ponds, guaranteeing exposure to the inevitable, powerful movements driven by human emotion and macroeconomic shifts somewhere on the planet. Decision 2. The entry, when to initiate a position. The entry decision is where Koval strips away all complexity and reveals the trend follower's beautiful simplicity. The goal is to define a rule that signals when a market is unequivocally moving and beginning a new trend. The trend follower is deliberately late to the party. They do not attempt to buy at the bottom or sell at the top. That is the folly of the prediction myth. They wait for the price to confirm the movement, absorbing the risk of missing the initial move in exchange for the certainty that a trend is, in fact, underway. The most classic and robust trend-following entry signal is the breakout system, exemplified by the Donchian channel, which is fundamentally a lagging indicator. The rule is simple and mechanical. By when the price closes at a new high or low, over a defined look-back period, e.g. 20 days, 55 days, or 100 days. If the price of Bitcoin closes above its highest closing price of the last 60 days, the system issues a buy signal. If the price of a meme stock closes below its lowest closing price of the last 20 days, the system issues a short signal. There is no subjective interpretation, no need to look into the market's reasoning, and no use of complicated moving average crossovers or volume metrics that are themselves derivatives of price. The signal is based purely on the historical price extreme. This ensures objectivity. The rule is either met or not met. No human emotion can interfere. Action. The signal forces a trader to enter the market when a human instinct is often to hesitate due to fear of the high price. They are systematically forced to buy high. In the context of modern algorithmic trading, the simple entry rule mimics the action of quant strategies. React immediately to a clear, objective price movement. While sophisticated algos use complex math, the fundamental principle remains the same. The entry is a mechanical response to a statistical extreme, validating that the collective market force has overwhelmed the prior trading range. Decision 3. The stop loss when to get out of losing trade. Koval declares the stop loss decision, to be the most critical component of the entire strategy, the survival mechanism. Without an absolute predefined stop loss, the system has no edge, and the trader is simply gambling, engaging in the self-destructive cycle of hope and fear. The stop loss must be set before the trade is initiated, and it must be based on a measure of the market's inherent volatility, not on a subjective percentage. This is the application of the average true range, ATR. ATR is a measure of how much an asset typically moves over a given period. By setting the stop loss based on a multiple of the ATR, e.g. 2x ATR, the stop is automatically adjusted based on the nature of the asset. A highly volatile asset, like a crypto coin, will have a wider, more permissive stop loss. A less volatile asset, like a long-term ETF, will have a tighter, closer stop loss. The psychological genius of this rule is that it converts a potential, open-ended disaster into a finite, acceptable cost. When the price reverses and hits the stop loss, the system doesn't say, "You are a bad trader." It says, "The market has given a new truth. This trend has failed, and the maximum allowed cost has been paid. Exit now." The exit must be instantaneous and unemotional. This mechanical stop loss is the only defense against the financial ruin caused by leverage addiction. The trader using high leverage in an option gambling strategy often fails to define their exit, believing they can endure the volatility. When the market moves against them, the leverage amplifies the loss, turning a temporary drop into a margin call and an account wipeout. The trend follower, by contrast, has their exit mathematically defined, ensuring that even if they are wrong on 70% of trades, no single trade can fatally injure the account. The stop loss is not merely a trading rule. It is a capital preservation mandate. The first rule of survival. Decision 4. Position sizing. How much to buy or sell. If the stop loss is a survival mechanism, position sizing is the profit engine. This is the mathematical core of Koval's strategy, and it is the single greatest difference between professional systematic trading and amateur speculation. This rule answers a question: how many units, shares, contracts, etc. should I buy so that if my stop loss is hit, I lose only a predefined tiny fraction of my total account equity? The trend followers define this fraction as a small percentage, typically 1% to 2% of total capital. The calculation is systematic. Define risk per trade are, e.g., 1% of total account capital. Define volatility of the asset, ATR the distance from the entry price to the stop loss price. Calculate unit size. Divide R by ATR. $text unit size equals \frac text account capital times text risk percentage text volatility distance to stop loss. This formula ensures that every trade, whether it's a highly volatile commodity or a stable currency, carries the exact same dollar risk to the total account. This is a sophisticated, yet deceptively simple concept of risk parity applied to the trading level. This single, mechanical rule governs two critical aspects of performance. Survival. It guarantees that even 10 consecutive losing trades, a deep drawdown, will only deplete the account by 10%, leaving 90% to wait for the next major trend. Maximizing winners. When the system catches a powerful, sustained trend, the position is sized optimally to maximize the impact of that run. Furthermore, the system often includes rules for pyramiding, adding to a winning position as the price moves further into profit, always using the same 1 to 2% risk rule to calculate the size of new units. This is a mechanism by which the trend follower compounds their success and generates a fat-tailed, exponential returns discussed in Chapter 2. A retail trader engaged in day trading psychology in the 2020s often makes a mistake of buying a fixed dollar amount of every stock, regardless of its volatility. They buy $1,000 of a volatile biotech stock and $1,000 of a stable utility stock. If the volatile stock drops 10%, the loss might be 5% of their total account, while the stable stock drops 1% for a negligible loss. The trend follower's unit size calculation corrects this flaw, ensuring that the biotech stock might be traded with 100 shares and the utility stock with 1,000 shares, so that a hit on the stop loss for either trade result in the same, controlled 1% loss. Decision 5. The exit when to take profits. The final, and perhaps most psychologically challenging, decision is the exit rule for a winning trade. Koval makes it clear that the trend follower's objective is to let profits run, to be willing to capture the entire 500% or 1,000% move that constitutes a generational trend. The cardinal rule of this section is, never use a profit target. A fixed profit target, e.g., I'll sell when I double my money, is a concession to emotional gratification and dramatically caps the potential of the system. It is the definition of selling too early, the most common psychological mistake of the amateur. The systematic solution is the trailing stop. Once a trade is profitable, the stop loss is moved up or down, if short, to a level that trails the price action. It is often based on the same volatility metrics used for the initial stop loss. Rule: the trade remains open as long as the price continues to trend and does not violate the trailing stop level. Execution: the system effectively gives the market a large enough buffer to consolidate and breathe, e.g., a 2x ATR cushion. If the price pulls back past that cushion, the market is telling the trader that the trend is broken and the exit is executed. The profit is locked in mechanically, not based on the trader's fear that the profit might vanish. This is the anti-FOMO mechanism. The retail trader, seeing their Tesla or Bitcoin position up 300%, feels compelled to sell, fearing a correction. They sell too early, only to watch the asset continue double or triple again. The trend follower is immune to this fear because they have a defined exit rule. The only emotion they allow is the joy of seeing the profit grow, secure by the mathematical certainty that their system will lock in the bulk of the gain when the market itself signals the reversal. The exit is purely a reaction to the market's behavior, not the trader's internal state. Modern investing reflection, algorithmic efficiency, the entire trend-following strategy detailed in this chapter, the mechanical entry, the volatility-based position sizing, and the trailing exit, is in essence a manually operated version of algorithmic trading. When one looks at modern quant strategies, they are built on these exact 5 pillars. Broad universe, trading every liquid asset globally. Mechanical entry, using price action threshold for non-discretionary entry at volatility-based sizing. Scaling positions based on the asset's risk profile, risk parity. Absolute risk control, hard, predetermined stop losses. Letting profits run, using complex trailing stop models to capture massive moves. Koval's enduring lesson is that the individual trader does not need to master complex mathematics or build a supercomputer. They only need the emotional discipline to execute the simple, robust rules of the system as perfectly as a machine. The challenge of this strategy is not intellectual. It is entirely temperamental. When a crypto hype cycle begins, the system demands a massive position be taken because the volatility, and thus the potential reward, is immense. When the inevitable drawdown hits, the system demands that the trader ignores the noise and the panic, trusting that the system's positive expectancy will assert itself over time. This strategy is not about high IQ. It is about high adherence. By adopting these 5 mechanical steps, the trend follower bypasses the emotional pitfalls that destroy the discretionary trader, enabling them to systematically harvest the profits generated by the manic greed and fear of the wider market. Chapter 7. Managing Risk and Money. If Chapter 6 provided the physical structure of the trend-following strategy, Chapter 7, Managing Risk and Money, serves as the vital operating manual for long-term survival and exponential compounding. Michael Koval does not treat this chapter as a mere auxiliary. He presents money management or risk control as the primary function of the systematic trader, relegating the act of finding the trend to a secondary, mechanical task. This is a chapter that separates the temporary speculator from the enduring financial master. The core lesson is brutally simple. The single most important factor in long-term trading success is not genius entry timing, but the mathematical certainty of survival. This chapter moves beyond the generalized concept of the stop loss and delves into the specific, calculated metrics that ensure the trader remains in the game long enough to capture the inevitable, life-changing trends. The tyranny of the drawdown. The human perception of loss is asymmetrical to the mathematical reality of recovery. Koval stresses that the greatest threat to a trading account is the drawdown, the percentage loss from a peak equity value. The tyranny of the drawdown lies in the fact that recovering from a loss requires a disproportionately larger gain. A 10% loss requires an 11% gain to recover. A 25% loss requires a 33% gain to recover. A 50% loss requires a 100% gain to recover. A 90% loss requires a $/math 900 $% gain to recover. This mathematical fact is a foundational argument for the strict position sizing rules detailed in the previous chapter. The reason the systematic trader risks only 1% to 2% of their capital per trade is not to maximize profit. It is to minimize the probability of catastrophic drawdown. They understand that one massive, uncontrolled loss can wipe out months or years of smaller, hard-won gains, or worse, put the account into a hole from which recovery is mathematically improbable. The traditional investor, fueled by hope or ego, often tries to average down on a losing position, thinking they are achieving a bargain. This is the surest way to invite a catastrophic drawdown. The trend follower views his behavior as a betrayal of the survival mandate. They accept the small mechanical loss, knowing that the capital saved is far more valuable than the ego's satisfaction of being eventually right. Capital preserved is firepower for the next, potentially enormous, trend, the power of volatility-adjusted position sizing. As explored in Chapter 6, the heart of sound money management lies in using volatility, specifically the average true range ATR, to define risk and determine the appropriate size of trade. Koval emphasizes that a fixed dollar risk per contract or share is amateurish because it ignores the inherent danger of the asset itself. The professional trend follower, using the ATR, ensures that the market dictates the size of the bet. The fundamental questions become, what is the inherent volatility of this asset, measured by ATR, which tells us how much the price moves typically? How far away is my stop loss based on this volatility? The risk unit. How many units can I buy so that this risk unit equals exactly 1 to 2% of my entire account equity? This methodology ensures that a massive short position in a high volatility crypto future and a massive long position in a relatively stable government bond future carry the exact same risk exposure to the overall portfolio. This creates true risk diversification across the entire trading universe. This is the essence of risk parity for a trend follower, and it is a mathematical moat against correlated catastrophe. This systematic approach is the only way to effectively participate in the high-stakes, high-leverage world of modern speculation without being instantly consumed. The retail investor engaged in option gambling often buys a fixed number of contracts, exposing themselves to undefined, massive losses. The systematic trader uses the ATR to calculate the exact number of contracts or shares that equate to their 1% risk rule, ensuring potential loss is always manageable. They trade large by defining small, manageable risks. The concept of systemic exposure and correlation. True risk management extends beyond controlling the risk of a single trade. It requires controlling the overall systemic exposure of the entire portfolio. Koval addresses the necessary structural rules for limiting exposure, recognizing that even well-sized, diversified trades can become correlated during periods of intense market stress, such as a major financial crisis or a sudden global inflation wave. The trend follower institutes rules to limit total exposure. Max loss per asset group. Never risk more than a defined amount across all trades within a highly correlated group, e.g., all energy commodities or all tech stocks. This prevents a simultaneous, crushing blow if that specific sector sees a sudden, unified reversal. Max loss per direction. Never risk more than a defined amount on all long trades or all short trade combined. This ensures that the portfolio is not wiped out by a massive, unified market reversal, e.g., a sudden, powerful crash that simultaneously hits all long positions. Equity drawdown reduction. This is the most brutal rule, yet the most critical for survival. The rule mandates that the account equity falls by a certain percentage, e.g., 10% or 20%. The trader must automatically and mechanically reduce the size of all future trades by a corresponding percentage. This acts as an automated belt-tightening mechanism, reducing the velocity of losses when the system is in a difficult, choppy environment. This layered approach to risk is what allows trend followers to survive and often thrive during global financial crises. When panic hits, correlated assets that should be non-correlated often fall together. The trend followers' systemic rules force them to reduce their bets during peak volatility, preserving capital when others are being liquidated, and keeping them ready to capitalize when the new, powerful trends, the panic selling itself, emerge. The role of compounding in the exit strategy. Money management is also the engine of profit maximization. Koval explains that the secret to the trend followers' wealth is not a steady stream of small gains, but the power of geometric compounding achieved by letting winners run. 1. Compounding through the win. The position sizing formula, Decision 4 in Chapter 6, is reapplied after every profitable period. As the account equity grows, the 1% risk dollar value increases. This means the system is systematically increasing the size of subsequent positions. This is compounding by design. Winning trades lead to a larger account, which leads to larger position sizes, which leads to capturing an even larger dollar amount on the next massive trend. This geometric growth is the only known method for creating the explosive wealth seen in the trend-following results. 2. Compounding through pyramiding. Koval confirms that the true masters of money management maximize their winners by pyramiding, adding new units to a position as the trend continues in their favor. However, this is done with absolute discipline. Every new unit added is sized to risk the same 1 to 2% of the current equity from its own stop-loss point. The trader is not simply doubling down on a hunch. They are systematically maximizing exposure to a confirmed, active trend, leveraging the market's continued truth while maintaining strict risk control on the new capital addition. 3. The unemotional exit. Finally, sound money management requires a complete removal of emotional exit points. Koval reiterates that taking profits based on a fixed dollar amount or a feeling of enough is a violation of money management principles, as it caps the exponential potential of the system. The trailing stop is the only acceptable exit rule because it ensures that the market, not the trader's fear, dictates the size of the profit. This is the crucial distinction between a speculator happy with 20% and a trend follower who captures 500%. Modern investing reflection, the antidote to hyperspeculative behavior. In the modern landscape defined by hyperspeculative behavior and the rapid amplification of greed and fear via digital markets, Koval's rules for risk and money management are the only reliable antidote to self-destruction. The ease of access to cheap leverage through technology has created a market where retail traders can destroy an account in minutes. The psychological high of day trading psychology in the 2020s encourages the belief that profits are easy and risk is optional. This leads to traders violating the 1 to 2% risk rule, placing 10% or 20% of their capital on a single bet, the exact opposite of systematic discipline. The trend followers' strict rules provide the necessary guardrails. By forcing the trader to define their loss first stop loss, size their bet based on that loss position sizing, limit total exposure, systemic rules, they create a trading environment that is insulated from the emotional volatility of the digital crowd. They use the energy of social media financial panic cycles as fuel for their system, while their own risk exposure remains mathematically controlled. Chapter 7 ultimately teaches that mastering the markets is not about making money. It is about not losing money. If you control your losses with mathematical precision, the nature of trends and compounding guarantees that the profits will eventually take care of themselves. Risk management is the trend follower's commitment to self-preservation, ensuring they're always available to ride the next great wave of market euphoria or despair. Chapter 8. The Great Trend Followers. After laying down the philosophical and mathematical groundwork, Michael Koval dedicates Chapter 8 to the living proof that this counterintuitive system works. The Great Trend Followers. This chapter is a crucial antidote to the skepticism that arises when confronting the low win rate and choppy drawdowns inherent in the strategy. It moves from abstract principles to concrete examples, chronicling the careers of legendary traders who systematize their success, often performing their best during periods of peak market chaos, when the discretionary traders were decimated. Koval's purpose here is twofold. First, to establish the historical legitimacy of trend following, and second, to demonstrate that the massive wealth accumulated by these masters was a direct result of their unwavering adherence to mechanical rules, not their charisma, market predictions, or exceptional intellect. The original master, Ed Seykota. Any discussion of trend following must begin with Ed Seykota, often cited as the true pioneer who fused systematic rules with computerized testing in the 1970s. Seykota is the philosophical grandfather of the entire movement. His contribution was demonstrating the power of mechanical rules executed with fidelity. Seykota's legend is rooted in his early success managing client accounts based on simple mechanical trading systems. His returns were astronomical, famously turning one client's $5,000 account into roughly $15 million over a 12-year period. This success was achieved not by attempting to predict global economic shifts, but by defining the trend simply, using basic moving averages and price breakouts, trading diverse assets, applying the same rules across commodities, futures, and currencies, ruthless risk management, adhering to strict stop losses, pyramiding aggressively, systematically adding to winning trades to capture the bulk of the trend. Seikoda's legacy is the perfect illustration of the principles in action. He proved that the system's edge was statistical and structural. He wasn't a genius who saw the future. He was a brilliant system designer who had the emotional discipline to execute his own rules without deviation. His mantra essentially was, find a system with a positive expectancy and execute it perfectly. This is the ultimate rejection of the myth of the financial genius, Chapter 3. Seikoda's returns were not smooth. They were fat-tailed, as discussed in Chapter 2, characterized by long, flat periods followed by explosive, parabolic surges when he caught a massive trend. The Turtle Traders, the ultimate proof of concept. The Turtle Traders experiment, led by Richard Dennis and William Eckhart, remains the most powerful and famous evidence for the viability of systematic trend following. Koval highlights this experiment not just as a historical anecdote, but as a foundational proof that trading can be taught, provided the focus is on process and discipline. The core success factors of the Turtles, relevant even to the day trading psychology in the 2020s, were equal opportunity. The participants came from non-financial backgrounds, demonstrating that background knowledge fundamentals was irrelevant compared to adherence to the system. The system's simplicity. The rules given were based on simple, price-based breakouts and volatility-adjusted position sizing, ATR. The Turtles made millions using a strategy that was intellectually accessible but emotionally demanding. Systemic defense against emotion. The detailed rules, entry, exit, position sizing, were a psychological cage, preventing the Turtles from selling too early, holding too long, or betting too much. They were forced to be machines. When the global financial markets experienced crises, be it the commodity spikes or crashes of the 1980s, the Turtles' performance was often exceptional. This was because their system was designed to profit from volatility, which is a physical manifestation of panic and euphoria. While traditional discretionary traders were paralyzed by fear, the Turtle system automatically generated short signals and sized their bets to capitalize on the downward trends. This resilience proved that the strategy's strength lies in its non-correlated crisis performance. The modern masters, John W. Henry, and the managed futures industry. Koval expands the narrative beyond the 1980s, showcasing how the principles matured into a robust, institutional strategy known as managed futures or commodity trading advisors, CTAs. John W. Henry, famous in the sports world as the owner of the Boston Red Sox and Liverpool FC, built his immense fortune on trend following. His firm and others like him institutionalized the simple rules of the Turtles, applying them across vast, global markets with high-tech execution. The significance of these modern masters lies in the scale and persistence of their success. Long-term resilience. These firms have generated wealth across multiple decades, surviving the dot-com bubble, 9/11, the 2008 financial crisis, and the volatility of the 2020s. Their longevity proves that the underlying principles are timeless and adapt to any market structure. Crisis Alpha. Koval's data clearly shows that the trend followers typically generate their highest absolute returns during systemic crises. When ETF dominance causes passive portfolios to plunge, the CTA firms are generating massive profits by shorting indices, bonds, and currencies in unified panic. This is the ultimate case for adding a trend-following allocation as a true portfolio hedge, or crisis alpha. The anti-discretionary model. The success of these multi-billion-dollar firms is fundamentally based on automation, mathematical rigor, and the removal of the human fund manager's daily discretion. The only discretion they employ is in designing and refining the systematic rules. But once deployed, the system runs with machine-like fidelity. This institutionalized success provides a vital lesson for the average investor watching the crypto casinos and meme stock manipulation today. If the world's most sophisticated capital managers rely on a systematic, unemotional strategy to capture market trends, the individual trader must recognize that relying on intuition, the hot tip, or the latest social media hype is a fundamentally inferior, high-risk approach. The path to institutional-level returns is paved with systematic discipline, not personal genius. The psychology of adherence, what made them great. Koval identifies a single, unifying characteristic among all the great trend followers, and it is not technical skill. It is temperament. These masters were successful because they had the unique psychological makeup to endure the strategy's inevitable discomfort. The systems they ran were designed to be robust, but their performance data demanded patience to endure choppy markets. They endured long, flat, small losing periods, whipsaws, without abandoning the system, knowing they were simply paying the search cost of the next massive trend. Guts to execute stop losses. They liquidated positions for a mechanical loss without hesitation or debate, even when they still fundamentally believed in the asset. Courage to trade big. When a massive trend was confirmed, their position sizing rules forced them to place a much larger bet than their emotions might have allowed, capitalizing fully on the opportunity. Humility to follow price. They had no ego invested in being right about the company. Their only loyalty was to the rules. This profound emotional detachment is the true Holy Grail, Chapter 1, that Koval reveals. The system provides a mechanism, but the trader provides emotional fidelity to execute it. The great trend followers were masters of process because they were masters of self-control, effectively turning themselves into robo-advisors before the technology even existed. Modern investing reflection. The replication of success. In an age where retail investors have access to global markets and fractional shares, Koval's profiles offer a clear blueprint for replication. You do not need the budgets of a CTA firm. You need their mindset. The tools of the trend masters, moving averages, ATR, and breakout levels, are all readily available on every modern zero-commission trading platform. The modern challenge is not access, but the distraction created by social media financial panic cycles and the cult of the quick trade. When a financial TikTok guru promises a secret indicator, the educated investor should reflect on the careers of Ed Seykota and John W. Henry. Their secret was public and simple: position sizing, risk control, and execution. They succeeded by trading dozens of assets, ensuring their exposure was diversified away from a single market collapse. This chapter ultimately serves as the ultimate motivation. The success of the great trend followers proves that following a systematic set of rules, designed around capital preservation and trend capture, is one of the most reliable methods for generating massive, uncorrelated wealth over the long term. Their data doesn't lie. They were paid handsomely for their discipline, not their predictions. Chapter 9, Emotions and Decision-Making. Having established the structure of the system, Chapter 6, and the imperative of risk management, Chapter 7, Michael Koval turns his focus inward in Chapter 9 to address the single greatest point of failure for any trader, regardless of how brilliant their system is: human emotion. This chapter is a deep dive into trading psychology, arguing that the greatest challenge in trading is not the market, but the flawed, wired-in decision-making process of the human brain. The trend-following system is, ultimately, a magnificent machine designed to eliminate the trader's emotional participation and thus circumvent the most common psychological pitfalls. The core realization Koval demands is this: the market is a probabilistic environment where profits accrue over hundreds of trades, while the human brain is hardwired for certainty and instant gratification. This fundamental mismatch is what destroys most accounts. The twin evils, fear and greed. All catastrophic trading errors can be distilled down to the influence of two primal emotions: fear and greed. 1. Greed, the impulse to anticipate and override. Greed manifests in several destructive ways, all rooted in the desire for a bigger, faster, more satisfying outcome, which is a direct extension of the lure of the Holy Grail, Chapter 1. Anticipating the entry. Greed pushes a trader to jump into a position before the systematic entry signal is triggered. They see the price rising and fear missing out, FOMO. So they buy early, often right before a natural market pullback, resulting in an immediate loss. The system requires discipline to wait. Greed demands instantaneous action. Betting too big, leverage addiction greed convinces a trader to violate the 1 to 2% risk rule, believing that because they are certain about this particular trade, they should maximize the payout by using excessive leverage. This is the hallmark of the retail investor in crypto casinos or engaged in aggressive option gambling. When the inevitable volatility hits, the oversized position is instantly liquidated and the account is wiped out, all because of the desire for an accelerated outcome. Selling too early. This is a paradoxical result of greed. When a position is profitable, e.g., up 100%, greed tempts a trader to take the money off the table now, fearing the profit will vanish. They prioritize the small, guaranteed gain over the large, potential run. This caps the profit potential of the system and prevents the fat-tail returns, Chapter 2, necessary for long-term success. The trader loses sight of the systematic goal, capturing the trend, and substitutes it with the emotional goal, securing the immediate dopamine hit of a realized profit. 2. Fear, the impulse to paralysis and avoidance. Fear is a psychological force that prevents the systematic trader from executing the necessary, painful action. Holding losing trades. This is the most common account killer. When a position hits the systematic stop loss, fear causes a trader to hesitate. They hope the market will turn around. Fear realizing the loss, and fear admitting they were wrong. They turn a small, defined loss, the system's intended outcome, into a catastrophic, undefined loss. The fear of small pain leads to the certainty of large pain. This is the ego tax in its most punishing form. Missing entries. After a period of painful drawdowns, choppy markets, fear makes a trader hesitant to execute the next entry signal. They are afraid of the whipsaw and the small, mechanical loss. The moment they hesitate and skip a trade, they risk missing the very next entry, which could be the start of the massive, system-saving trend. Fear ensures that the trader is never exposed when the market finally moves. Averaging down. Fear, combined with the illusion of the financial genius, Chapter 3, leads the trader to add to a losing position, doubling their bet and their risk. They are afraid of being proven wrong and desperate to lower their average cost, effectively throwing good money after bad in a desperate attempt to salvage a narrative that the market has already proven false. The system as an emotional firewall. Koval's ultimate lesson on emotion is that it cannot be controlled, only neutralized. The goal of the trend follower is not to become a perfect Zen master, but to remove the necessity of emotional decision-making from the process. The system is the firewall. By rigidly adhering to the rules laid out in the strategy chapter, entry rule removes the impulse to anticipate greed. Stop-loss rule removes the decision to hold a loser fear. Position sizing rule removes the ability to overbet greed. Trailing exit rule removes the temptation to sell early fear/greed. The trader, stripped of discretion, is left with only the task of execution. They are forced to act against their deepest human instincts, which is why the system is so effective. The success of the great trend followers, Chapter 8, lay not in their superior emotional control, but in their creation of an absolute mechanical shield against their own fallibility. Cognitive bias is amplified by digital markets. The emotional struggle of the trader is dramatically amplified by the high-speed, digitally connected markets of the 2020s. How digital markets amplify greed and fear is a critical modern reflection of Koval's timeless lessons. Availability bias and social amplification. Financial TikTok and YouTube gurus constantly trumpet massive, immediate wins. This creates an availability bias, making the average investor believe that 10x returns are common and easy. This hyper-focus on spectacular, infrequent outliers fuels greed and encourages a violation of conservative risk rules. The low win rate of the trend follower feels unbearable when every influencer is flashing a screenshot of a 500% gain. Confirmation bias in Tesla hype and Bitcoin bubbles. The human brain naturally seeks information that confirms its existing beliefs. In a powerful trend, traders intentionally seek out articles, news, and social media posts that validate their long position and ignore any negative price action. This confirmation bias is why investors hold on too long during the peak of Bitcoin bubbles. They are psychologically locked into the narrative of inevitable success and filter out the price truth that a reversal is occurring. Loss aversion and the zero-commission trading illusion. Studies show that humans feel the pain of a loss approximately twice as powerfully as the pleasure of an equivalent gain, loss aversion. Zero-commission trading apps facilitate continuous, rapid trading, making small, repeated losses feel insignificant until they suddenly aggregate into a large, painful drawdown. This causes traders to double down or seek out high-risk shortcuts, the grail, to quickly erase the pain of recent losses, rather than patiently adhering to the systematic process. The emotional battleground has moved from the trading floor to the smartphone screen, making discipline harder than ever. Koval's system provides the anchor, grounding the trader in the cold, mathematical reality of their 1% risk rule, forcing them to disengage from the emotional contagion of the digital crowd. The practice of detachment. The professional trend follower, therefore, views emotion not as a flaw to be corrected, but as a danger to be avoided. The practice of trading becomes a practice of detachment. Focus on process, not outcome. The trader must find psychological satisfaction in executing the system perfectly, not in the profit or loss of any single trade. A small loss executed flawlessly is a success of the process. A massive win achieved by overriding the rules is a failure of discipline. Accepting whipsaws. When the system hits 3 consecutive stop losses, a whipsaw, the trader must view it as a required cost of business in a choppy market, not as a personal indictment of their ability. This is the patient endurance required to wait for the system's edge to reassert itself. The unconditional exit. When the stop loss is triggered, the trader must treat the position like a mechanical failure. It is simply time to liquidate without hope, anger, or fear. Chapter 9 is the ultimate instruction in humility. It teaches that the market does not reward intelligence, analysis, or emotional stability. It only rewards systematic adherence. The path to financial mastery is achieved not by mastering the market, but by mastering the self. Specifically, by removing the self entirely from the moment of decision. Chapter 10, the big picture. With the philosophical hurdles cleared, chapters 1, 3, 5, and 9, and the mechanical execution detailed. Chapters 6 and 7. Michael Koval's Chapter 10 pulls back the lens to reveal the big picture. This is a synthesis of the trend-following methodology, demonstrating how the systematic approach allows the trader to step outside the daily noise and position themselves to capitalize on the massive, slow-moving macro shifts that shape global wealth. The ultimate power of the system is its ability to remain agnostic to the news, while being perfectly positioned to profit from the consequences of that news. The trend follower is, ironically, a macro trader, but without the burden of macro forecasting. They recognize that massive trends, whether economic booms, technological revolutions, or systemic crises, take years to play out, and their job is simply to ride the momentum created by these titanic forces until they fundamentally reverse. The macro view, global, systemic trends. The big picture perspective demands a global focus. Koval emphasizes that the most significant and profitable trends are rarely confined to a single stock or a single sector. They are systemic and cross-asset. Consider the global inflation waves of the early 2020s. This was not merely a stock market phenomenon. It was a systemic trend that impacted commodities. Prices of crude oil, natural gas, and copper soared, trend followers long. Bonds. Interest rates rose, causing bond prices to collapse. Trend followers short bond futures. Currencies of nations with hawkish central banks strengthened. Trend followers long certain currency futures. A traditional stock investor might have tried to profit by buying specific inflation-proof stocks, limiting their exposure. The systematic trend follower, however, saw the inflation wave as a unified, global macro trend and applied their simple breakout system across dozens of uncorrelated markets. They were long the energy futures, short the bond futures, and long certain currencies, capturing the movement from all sides. The system allows the trader to profit from the broad, long-term consequences of an event without ever needing to predict the event itself. This ability to view the entire global landscape as one interconnected, tradable unit is the true genius of the system. It ensures that the trader is never over-reliant on the success of a single economy or asset class, providing the structural safety needed to survive the inevitable localized crises. The 3 stages of a trend. Koval simplifies the complexity of market cycles by focusing on the trend follower's relationship to the 3 essential stages of any major trend, which are manifestations of the collective shift in market truth, Chapter 4. 1. Accumulation, the noise. This is the early stage when smart money or early believers, who often do have fundamental foresight, begin building their position. The price action is choppy, volatile, and lacks clear momentum. Trend followers action. The system is typically out of the market or being subjected to small whipsaw losses. The trader is patiently paying the search cost, Chapter 2, waiting for the trend to become undeniable. This is the period where the day trading psychology in the 2020s gets bored and leaves. 2. Momentum and participation, the profit. This is the stage where the price moves aggressively and consistently. The trend is now confirmed. The systematic entry has been triggered, and media narratives begin to validate the move. This phase is fueled by general investor confidence and FOMO. Trend followers action. The system is aggressively long or short, pyramiding additional units, decision for position sizing, to maximize exposure as the trend strengthens. This is where the bulk of the exponential returns are generated, exploiting the massive energy of the crowd's greed. This is a period of Tesla hype and peak Bitcoin bubble momentum that the system is designed to harvest. 3. Distribution and reversal, the exit. This is the final stage where the velocity of the trend slows, volume surges, often a sign of massive retail interest, and the price begins to fail to make new highs or lows. It is often accompanied by manic public interest. The financial TikTok and YouTube gurus are screaming about the asset. Trend followers action. The system ignores the noise and patiently follows the trailing stop, decision 5, the exit. When the inevitable reversal is strong enough to violate the trailing stop, the system exits mechanically, locking in a massive profit without trying to predict the exact peak. They are out of the market, having captured the majority of the move, leaving the volatile last piece for the late-stage emotional gamblers. The big picture is about understanding that the trend follower only generates profits during stage 2. Their job in stages 1 and 3 is purely risk management and patience. The role of technology, systematic versus discretionary speed. In the modern financial world, the concept of the big picture must address the role of speed and technology. Koval acknowledges that algorithmic trading and high-frequency traders dominate the nanosecond moves. However, the trend follower operates on a much slower, more powerful timeline. The great systematic trends, the multi-year runs in oil or the 5-year rise of an entire stock index, cannot be arbitraged away by high-frequency trading. These trends are fueled by human psychology, massive capital flows, like those dictated by ETF dominance, and macroeconomic shifts that take months and years to unfold. The trend follower system, though simple, mimics the discipline of the quant. While a human discretionary trader might take hours to analyze data, the AI-driven hedge funds and systematic trend followers have defined their reaction beforehand. The system provides a mechanism for human traders to execute at a speed that is emotionally non-discretionary, allowing them to capitalize on sustained, long-term trends that even the fastest algos must respect. The danger in today's market is that the illusion of speed, fueled by zero-commission trading, encourages traders to operate on a time frame that is too fast for human analysis and too slow for high-frequency profits. The trend follower solves this by focusing on the big picture trend, operating on a time frame weeks to years, where the fundamental rules of psychology and momentum still apply. Modern investing reflection, passive versus hyper-speculative behavior. The big picture provides a final, elegant solution to the dilemma of passive versus hyper-speculative behavior prevalent today. Passive investors, DCAs/FIRE, they have a big picture outlook, long-term economic growth, but lack a mechanism to profit from crises. They are systematically long only, forcing them to ride every major decline all the way down, simply waiting for the recovery. Their big picture is too simplistic, ignoring the inevitability of powerful, two-sided trends. Hyperspeculators, option gambling/meme stocks, they have no big picture and are obsessed with the immediate micro move. They trade on tiny, short-lived price oscillations and are often wiped out by the first significant reversal of the actual big picture trend. Their focus is too narrow and too fast. Trend followers, they hold the most complete big picture. They accept that the market moves in long, powerful, two-sided trends. Their system is designed to 1. Be long during the big picture economic expansion, like the passive investor. 2. Go short during the big picture economic contraction or crisis, like no passive investor can. This directional flexibility is the ultimate advantage of the trend-following system. It recognizes that the world is a complex place where global inflation waves cause asset prices to rise, and then subsequent central bank rate hikes cause those same asset prices to collapse. The trend follower profits from both phases, systematically turning the chaos of the macro environment into structured, managed risk and asymmetric profit. Ultimately, Koval's Chapter 10 teaches a systematic trader that their success is tied to the enduring power of global momentum, not the fleeting noise of the daily news cycle. By focusing on the mechanical execution of their system, they are perfectly positioned to capture the greatest movements of human capital across the planet, riding the biggest waves until the market itself signals the coast is clear. Chapter 11. The Psychology of Execution. Having synthesized a market view in the big picture, Chapter 10, Michael Koval brings the trend-following curriculum back to its most challenging and personal element, the psychology of execution. This chapter serves as a final psychological barrier, addressing the deep-seated mental obstacles that prevent even intellectually convinced traders from executing a perfect system. It is a manual for turning conviction into consistent action, stressing that the difference between the average speculator and the systematic master is not knowledge, but the discipline to act against one's own instincts. The system is perfect. The human is flawed. Therefore, the psychology of execution is the psychology of self-mastery through rigid mechanical adherence, the discipline of the mundane. The grand narratives of finance often focus on dramatic, high-stakes decisions, the brilliant prediction, the heroic rescue. Koval insists that systematic success is built entirely on the discipline of the mundane. Trend following is inherently boring for long periods. It is a monotonous, daily repetition of small, uncomfortable tasks that separates the winners from the losers. The core mundane acts that require the most discipline are executing the stop loss. This is the most painful, yet most necessary, act. It is easy to place the stop loss order when a trade is initiated, but when the market screams the truth that the trade is wrong, the psychological urge is to pull the order, wait, and hope. The true systematic mastery is the instantaneous, unemotional acceptance of a loss. This ritualistic, mundane act of cutting small losses is the bedrock of survival and the greatest proof of commitment to the system. Trading small consistently. The repeated mechanical use of the volatility-adjusted position sizing formula, Chapter 7, ensures that every trade is a small, controlled experiment. When a spectacular opportunity arises, a Bitcoin bubble starting its parabolic climb, the human mind screams to bet the entire farm. The system demands that the trader ignores the spectacle and adheres to the boring, mathematical 1% risk rule. This consistency guarantees that the account survives the 9 out of 10 trades that lose, so is fully capitalized for the one trade that wins, ignoring the noise. The daily market is saturated with noise, earnings reports, financial influencers on social media, political crises, and expert forecasts. The discipline of execution requires a trader to ignore 99% of this information. The only information that matters is the price action relative to the system's entry and exit points. This is the ultimate rejection of FOMO and seductive narratives that lead to poor decision-making, the problem of perfectionism and the need for probabilities. The pursuit of the Holy Grail, Chapter 1, often manifests as perfectionism in execution. The discretionary trader is obsessed with finding the perfect entry or the perfect exit, leading to analysis paralysis and hesitation. Koval addresses this by reinforcing the probabilistic nature of the system. Accepting imperfection. The trend-following system is designed to be wrong most of the time, low win rate. The system's edge does not come from being right on every trade, but from capturing massive profits on the few trades that become generational trends. Action over analysis. When the system gives an entry signal, e.g. a breakout, the trader's job is to execute immediately, even if the price is a few cents away from a perfect fill. The loss of a few cents is negligible compared to the loss of the entire multi-month trend that the delay might cause. The systematic approach rewards decisive, immediate action over paralyzed analysis. The law of large numbers. The true power of the system is only revealed over hundreds of trades. The individual trade is meaningless. It is merely one data point in a statistical series. The psychology of execution demands that the trader views each trade not as a bet on an outcome, but as a necessary probabilistic trial required to prove the system's long-term mathematical edge. This perspective is crucial when confronting the emotionally charged world of meme stock manipulation. When a system gives a short signal on a popular, volatile asset, the trader's emotions might argue against it, citing the community's support. The execution psychology demands that the trader ignores the noise and views the short signal as a high-probability trial that, if wrong, will result in a small loss, but if right, could capture a massive, violent collapse. The psychological cost of system adherence. Koval is candid that adherence to the system comes at a psychological cost, specifically the pain of the drawdown. Drawdowns, those long periods where the account equity declines due to continuous small losses, whipsaws, are not a failure of the system, but feature the system in a choppy market, the emotional desert. During a drawdown, the trader is doing everything right, executing the stop losses perfectly, controlling risk, yet they are losing money day after day. This is the point where most traders fail, believing the system is broken and jumping to a new strategy, the next holy grail. The test of faith, the psychology of execution, requires a deep, almost religious, faith in the back-tested data. The trader must separate their current emotional discomfort from the historical, statistical proof that the system will work when the environment shifts back to trending conditions. The anti-emotional rule. Koval stresses that if the system's performance is within its statistically expected parameters, the trader must not change a single rule. Changing the system during a drawdown is the ultimate act of emotional surrender. It guarantees that the trader will miss the massive winning trend that inevitably follows a choppy consolidation phase. The finality of the machine. Ultimately, the psychology of execution is the willingness to become a machine. The best trend followers are often not the most brilliant, but the ones who are the most honest with themselves about their own emotional fallibility. They use the system to eliminate themselves from the process, accepting the superiority of rules over instinct. This is the central lesson for the modern trader facing unprecedented complexity and volatility. From crypto casinos to leverage addiction, the machine is the only entity capable of executing a perfect volatility-based position sizing calculation every time, cutting a large, potential loss instantly without hope, letting a massive profit run without fear. The year is 2021. You open your phone, and the screen is a kaleidoscope of green and red. A digital coin with a dog on it is up 500% in a week. Your friend, who just started trading 6 months ago, sends you a screenshot of a 6-figure profit from an options trade on a struggling retail stock. Every financial news site, every TikTok feed, and every family gathering is dominated by the same paralyzing question. Am I missing out? This is the sound of the modern market, a deafening cacophony of greed, fear, and unparalleled hype. It is a market defined by instant gratification, zero-commission apps, and a collective mania of the Robinhood generation, where the line between investing and outright gambling has become impossibly blurred. In this environment, the timeless principles of value investing and long-term holding often feel hopelessly slow, irrelevant, even stupid. Why wait 10 years for a 100% return when a single meme stock can deliver in a month? This relentless, suffocating sense of FOMO, fear of missing out, is the single most powerful force driving trillions of dollars in wealth today. But what if the very chaos and emotion that define this new era are not obstacles to be overcome, but rather the essential fuel for a strategy that has generated some of the greatest fortunes in financial history? What if there was a way to navigate the dizzying spikes of crypto hype cycles, the parabolic rises of stocks like Tesla, and the sudden, brutal collapses that follow, not by predicting them, but by simply following them? That is a radical, deceptively simple proposition at the heart of Michael Koval's seminal work, Trend Following. Learn to make millions in up or down markets. The siren call of prediction and the futility of foresight. For decades, the financial industry has been built on the illusion of prediction. We are taught to listen to the talking heads on television, the experts with their elaborate models, their earnings estimates, and their complex geopolitical forecasts. We pay exorbitant fees for fundamental research, believing that if we just analyze a company's balance sheet hard enough, or if we can successfully guess the next interest rate hike, we will somehow get a jump on the market. This need to predict, to be smarter than everyone else, is deeply ingrained in human nature. It feeds our ego and makes us feel secure. Yet, time and time again, from the dot-com bubble to the 2008 financial crisis, and most recently, the irrational exuberance of the 2021 market, the forecasters have been wrong. They failed to predict the implosion of the crypto exchange FTX. They failed to foresee the rapid, punishing wave of global inflation in 2022, and they certainly failed to call the top of the Bitcoin bubbles. Because predicting the future is fundamentally impossible. Koval's book shatters this illusion. It dismisses the entire apparatus of financial prediction, the analyst reports, the expert opinions, the economic forecasts, as noise. It proposes an entirely different, counterintuitive philosophy. Do not predict, simply react. The market itself is the only oracle you need, and its signals are not whispered secrets, but loud, undeniable movements. The author, the legend, and the history of the turtle traders. To understand the power of Koval's message, you must understand the history behind it, which is a foundational myth of modern trend following. Michael Koval is not a former Wall Street banker or a typical academic. He is a researcher, a documentary filmmaker, and an ardent chronicler of an incredibly successful, yet profoundly understated, approach to trading. His book is essentially a roadmap and a history lesson rolled into one, detailing the principles and performance of a select group of traders. The story begins in 1983 with two legendary financial minds, Richard Dennis and William Eckhart. They had a fundamental disagreement about whether great traders were born or made. Dennis, a highly successful commodity speculator, famously argued that trading could be taught. Eckhart believed it was an innate talent. To settle the debate, they launched an experiment that has since become known as the Turtle Traders Experiment. Dennis placed a newspaper ad and recruited a small group of ordinary people, from a security guard and accountant, who had zero prior trading experience. He gave them a simple, mechanical set of rules for trading futures markets across multiple asset classes, commodities, currencies, and bonds. The most important rule was not about fundamental analysis or economic forecasting, but about following the trend. Over a short period, this diverse group of complete novices, armed only with a systematic set of rules, reportedly made over $175 million. Koval's work is dedicated to excavating and analyzing this experiment and the subsequent careers of the great trend followers, people like John W. Henry, Edsay Coda, and Jerry Parker. These individuals, whom he refers to as the masters of the universe, were not interested in what made a stock cheap or expensive. They were only interested in whether it was moving up or down, and whether that movement was persistent. The book's relevance is not just historical. It lies in the uncomfortable truth that while technology and assets have changed, human psychology has not. The principles that made the turtles successful in the 1980s are precisely the ones that allow traders to capitalize on the manic rise of zero-commission trading platforms today, where every market movement is amplified by retail speculation, connecting timeless principles to the modern digital casino. The philosophy of trend following, buy high, sell higher, sell low, buy lower, seems utterly counterintuitive to the average person, especially those steeped in the principles of value investing. Yet, Koval brilliantly demonstrates how this mechanical, systematic approach is the perfect antidote to the emotional minefield of modern finance. The FOMO culture connection, the core fuel for trend following, is the same raw emotion that drives the FOMO culture. When a stock like GameStop or a cryptocurrency like Shiba Inu starts moving, it's not based on fundamentals. It's based purely on momentum, herd behavior, and the fear of missing the rocket ship. Traditional investor sees the rise, calls a bubble, and sits on the sidelines, paralyzed by skepticism and missing the 10x move. Trend follower sees the price rise, acknowledges that a trend is in motion regardless of the fundamental reason, and enters a trade. They are simply riding the wave created by the crowd's FOMO, and they exit mechanically when the crowd's fear signals the trend is breaking. They treat the emotional actions of the market as data, not as a trap. The FIRE movement and risk. The FIRE financial independence, retire early, movement emphasizes saving index funds and long-term asset allocation. This is a robust strategy, but it exists on the passive end of the investing spectrum. Koval's work, while not directly advocating for every individual to become a full-time speculator, provides a crucial framework for how professional, active traders think about risk and reward, lessons that are vital even for passive investors. Trend followers define their risk first. They know precisely how much they are willing to lose on any single trade, and they stick to that rule religiously. This mathematical, unemotional approach to risk management is the single biggest lesson any investor, from a day trader engaged in option gambling to a long-term retirement saver. The trend-following system, perfectly executed, is a final, evolved stage of trading mastery. It is a human harnessing the power of probability by removing the corrupting influence of the human ego and emotion. The final goal is not to trade well, but to execute the rules so perfectly that the quality of the execution becomes irrelevant to the personality of the trader. Modern context expansion. The core instructional material of trend following is timeless because it is rooted in human psychology and mathematical probability. However, if Michael Koval were writing the book today, with the benefit of a 2020's hindsight, he would not change the rules. He would simply point to the digital landscape as the ultimate validation and magnifier of the very trends the system is designed to exploit. The systematic principles of risk control and momentum harvesting are not outdated by modern technology. They are made more critical and more profitable by it. Here is what the author and the great trend followers would likely observe and comment on if they saw today's volatile, digitized, and retail-driven markets. The new velocity of greed and fear. The fundamental observation would be that technology has dramatically increased the speed and magnitude of emotional movements. Trends now form faster, rise higher, and collapse more violently than ever before. AI-driven hedge funds and algorithmic trading. Koval would see the rise of AI-driven hedge funds and complex algorithmic trading not as a threat to trend following, but as a confirmation of its core principles. Quants and AI systems succeed because they are systematic. They operate on predefined, non-discretionary rules. Agnostic. They care only about data, price/volume, not the narrative that risk controlled. Their models are mathematically constrained to specific volatility limits. In essence, these sophisticated firms are simply highly optimized, high-speed trend followers. The individual systematic trader is merely running a slower, human-executed version of the same program. The trend follower doesn't compete with the algorithms on speed. They compete on time horizon. The algos dominate the milliseconds. The trend follower dominates the multi-week and multi-month moves, which the algos themselves must respect as a massive, systematic shift in capital flow. The AI confirms the myth of the financial genius, Chapter 3, is dead. It proves that the machine is superior to the discretionary human brain. Quant strategies in fractional shares culture. The popularity of fractional shares culture and robo-advisors will be noted as systematic forces that create powerful, slow-moving trends. Robo-advisors, through automatic rebalancing and systematic investment, act as a predictable capital flow into specific asset classes, creating long, slow trends that can be easily followed. Similarly, the ability of millions of retail investors to systematically purchase fractions of high-priced stocks creates persistent, non-fundamental buying pressure that systematic traders can profit from. The trend followers would observe that the market is increasingly driven by two extremes: the emotionless speed of the quant on one end and the emotionally charged, systematic flow of retail capital on the other. Both extremes are systematic forces, and the trend-following rules are perfectly suited to profit from both. The amplification of speculation, meme stocks, and crypto. Koval's work would find its most vivid, real-time validation in the phenomena of meme stock manipulation and the crypto casinos. These are the purest forms of emotion-driven trends, unburdened by fundamental reality. Meme stock mania and social hype. The short-lived parabolic rise of meme stocks is the modern incarnation of the biggest, fastest trends Koval described. The fundamentalist, Chapter 5, was ruined trying to short these stocks based on traditional valuation. The systematic trend follower, however, would view this as a clear, high-volatility, short-term upward trend driven by unified social media financial panic cycles, specifically retail greed and institutional fear of the short squeeze. The system dictates the response. Entry, by when the price breaks out due to momentum. Sizing, size a trade small because the volatility is immense, forcing the ATR calculation to yield a tiny unit size for a 1% risk. Exit, ride the trend until the trailing stop is hit by the inevitable crash, locking in the vast majority of the gain. The trader is agnostic to the social narrative. They are only harvesting the energy. The lesson is that the market is the ultimate truth, Chapter 4, and even irrational momentum is a trend to be followed. Crypto casinos and NFT madness. The entire ecosystem of crypto casinos, volatile altcoins, and NFT madness is the ultimate proving ground for Koval's principles. This market is characterized by extreme volatility, high leverage addiction, and the constant search for the Holy Grail. the next 100x coin. A trend follower would see these assets as fantastic trend vehicles. High volatility. The huge price swings generate massive trends, high potential reward. Clear signals. Because the market is purely driven by sentiment and liquidity, the technical trends are often sharp and unmistakable. The key lesson here for the modern investor is risk management, Chapter 7. The only way to survive a market with 100x leverage in daily 50% swings is to rigidly adhere to the 1% risk rule. The volatile nature of crypto forces a systematic trader to trade extremely small unit sizes, ensuring that the necessary dramatic stop losses, e.g., a 20% drop, only translate into a 1% loss of the total account. Trend followers profit from the volatility that destroys the emotionally driven speculator. The central conflict of the 2020s is between the ultra-passive approach, DCA, fire-based asset allocation, and the ultra-aggressive approach, leverage, option gambling. Koval's system occupies the logical, profitable middle ground. DCA/passive, excellent for long-term growth, but structurally incapable of profiting from the massive downward trends created by global inflation waves or systemic crises. They ride a 40% crash to the bottom, losing massive time to recovery. Trend following possesses the directional flexibility to be long when the market is rising and to systematically short the market, stocks, bonds, currencies, etc. when the panic begins. It provides a crisis alpha that is missing from every passive portfolio. The trend follower uses the discipline of the passive investor, adherence to a system, and combines it with the directional agility of the speculator, turning market chaos into non-correlated profit. How digital markets amplify greed and fear. The author would stress that cheap leverage through technology has not changed human nature. It has simply given our worst instincts a high-speed engine. Amplification of greed. The ability to execute a trade and see the potential profit instantly, via app notification, releases an immediate dopamine hit, reinforcing the destructive impulse toward hyper-speculative behavior and overbetting. Amplification of fear. Social media financial panic cycles distribute fear at the speed of light. News that took days to travel in the 1980s now causes an instantaneous collective emotional crash. The only defense against this emotional contagion is a mechanical adherence to the stop-loss rule, the system's instantaneous reaction to the truth of the price, ignoring the emotional noise. The final word on a modern context would be a solemn reassurance. The chaos, the speed, and the complexity are irrelevant. The market will always trend because humans will always react emotionally to price movements. The systematic trend follower, by running a simple, machine-like set of rules, is perfectly positioned to harvest the enormous energy of the digitized crowd. The game is the same. The stakes and the velocity are simply higher. Closing reflection. Having meticulously broken down the philosophy, mathematics, and execution of systematic trend following, we arrive at the closing reflection. This final section distills Michael Koval's profound and often counterintuitive lessons into a concise set of timeless principles that any individual, regardless of their capital or background, can apply to navigate the chaos of the modern financial world. The ultimate takeaway from this exhaustive study is that success in the market is not a product of brilliance or prediction, but of patience, emotional discipline, and a mechanical commitment to rules. 10 timeless principles from trend following. The path of the trend follower is defined by a commitment to process over prediction. These principles represent the essential creed for survival and profit. 1. Price is the ultimate truth. Rejection of the narrative. Never debate the market. If the price action on your screen contradicts your fundamental analysis, your gut feeling, or the advice of a financial guru, assume the price is right and your opinion is wrong. The current price is the aggregated, factual consensus of all global participants. Follow the price. 2. Risk management is job 1. Survival above all else. The primary goal of trading is not maximizing profit, but preserving capital. Define your maximum allowable loss, 1% to 2% of total capital, before entering any trade. Every loss must be small, controlled, and statistically acceptable, without rigid risk management. Every strategy is simply gambling, especially in the era of cheap leverage through technology. 3. Cut losses without exception. The anti-ego rule. When a position hits the predetermined stop loss, execute the exit instantly and without hesitation. The market is telling you the trend has failed. Holding on turns a small, defined loss into a catastrophic, undefined one. The fastest way to wealth is to avoid account destruction. 4. Let profits run. The wealth engine. Never use a fixed profit target. Do not sell simply because you feel you have made enough. Let the trailing stop rule dictate the exit, ensuring you capture the full magnitude of the fat-tailed returns that power the system. Selling early is the most common form of psychological self-sabotage, capping your exponential potential. 5. Trade a diverse, global universe. The anti-correlation shield. Do not specialize in one stock or sector. Spread your capital across a wide, non-correlated universe of assets, stocks, bonds, currencies, commodities. This ensures that when one market is in a choppy drawdown, another market, somewhere in the world, is developing the massive trend that will generate the year's profits. 6. Execution must be mechanical. Remove yourself. The system is a shield against the twin evils of fear and greed. Execute your entry, position sizing, and exit rules mechanically without discretion. The best traders are those who successfully transform themselves into emotionless machines that adhere perfectly to a mathematically sound process. 7. Accept the low win rate. Focus on asymmetry. Understand and accept that your system will be wrong most of the time, often less than 40% win rate. This is irrelevant. The enormous asymmetric profits from a few large winners will mathematically overwhelm the many small, controlled losses. Do not confuse frequent losing with overall failure. 8. Know the cost of doing business. Patience and drawdown. Accept that long, uncomfortable periods of flat or declining performance, drawdowns or whipsaws, are not a failure of the system, but the necessary cost of doing business in a non-trending environment. The discipline to stick to the system during the low-win periods is a prerequisite for catching the subsequent high-profit trend. 9. Trade based on volatility, not dollars. Position sizing is key. Use a volatility-based metric like ATR to calculate the precise size of every trade. This ensures a highly volatile asset, like a crypto coin, and a stable asset, like a government bond, carry the exact same risk exposure to your portfolio. This is the difference between controlled speculation and pure gambling. 10. Embrace the power of compounding. Systematic growth. As your account equity grows through captured trends, your system must automatically increase the size of your subsequent bets, while maintaining the 1% risk rule. This is the engine of geometric compounding, turning the incremental gains from discipline into exponential, long-term wealth. Application for the normal person today. The genius of Michael Koval's work is that these principles are not just for professional speculators. They are essential survival skills for the Robin Hood generation navigating the current market environment defined by volatility, FOMO, and hyper-speculative behavior. 1. Applying the stop-loss to long-term portfolios. The core lesson of risk management applies directly to the individual using dollar-cost averaging, DCA, or fire-based asset allocation. While these investors may not trade futures, they must define their maximum tolerable decline. The emotional stop-loss, an individual must decide, if my passive portfolio drops 30% from its peak, will I panic and sell? If the answer is yes, their emotional stop-loss is 30%. They must manage their allocation now to ensure they never breach that emotional threshold. Koval's work teaches that undefined risk is the greatest danger, even in a long-term retirement account. 2. Filtering noise and ignoring the guru. The principle of price is truth is the ultimate filter for the noise generated by financial TikTok and YouTube gurus. If a guru is pumping a stock, ask yourself, is the price actually trending or am I being tempted by a narrative? If the price breaks down, ignore the guru's defense and listen to the market's truth. This simple skepticism protects the individual from meme stock manipulation and the herd mentality of social media financial panic cycles. 3. Emotional discipline, the long-term game. The most important application is the emphasis on emotional discipline and long-term thinking. The trend follower accepts that true wealth is not generated by the quick, easy wins that are flashed on screens, but by the patient, decade-long adherence to the system. The challenge of modern investor is to develop the calmness and patience to watch others get rich quickly without abandoning their own process. Patience. The market rewards the disciplined over frantic. If you are DCing into index funds, the trend follower's lesson is to keep buying during the drawdown. Understand that the drawdown is simply the cost of doing business and the precursor to the next long-term trend. Emotional discipline. When global inflation waves cause market chaos, the systematic mind remains calm, focusing on execution, DCA rebalancing, rather than panic selling. The systematic view turns every crisis into an opportunity, provided the trader has preserved their capital and emotional energy. Deep, powerful closing thoughts. The enduring legacy of Michael Koval's work is the elegant simplicity of its conclusion. The markets are not rigged. They are not impossibly complex, and you do not need a special degree to profit from them. The market is merely a vehicle for transporting wealth from the impatient and undisciplined to the patient and systematic. The great fortunes of the trend followers were not built on secret knowledge, but on the profound understanding that humans create trends and rules capture them. In a digitized world where greed and fear are amplified at the speed of fiber optics, the advantage of the systematic trader, the one who has removed their ego and their emotion, is greater than ever. The path forward is clear. Define your risk, commit to your rules, ignore the noise, and wait patiently for the trends to emerge. If you can master the psychology of execution, Chapter 11, and adhere to the discipline of the mundane, the enormous, chaotic forces of the market will eventually reward your commitment. The journey through the core principles of trend following by Michael Koval ends here, but your journey as a systematic trader is just beginning. If the last hour has achieved anything, it is to prove that the greatest obstacle to wealth is not the complexity of the market, but the fragility of a human mind. You've seen how the legendary trend masters built staggering fortunes not by predicting the future, but by possessing the unwavering discipline to execute a simple, powerful mathematical system. You've learned that patience is the ultimate weapon, risk management is the foundation of survival, and that the biggest profits come from having the courage to stick to the rules when every emotional impulse screams at you to panic or to be greedy. The digital markets of today, with their crypto bubbles, meme stock hype, and constant social media panic cycles, are simply a new, faster engine for human emotion. And where there is powerful, persistent human emotion, there are massive, profitable trends waiting to be systematically harvested. The system is your shield. Your adherence to it is your superpower. Do not seek the Holy Grail. Do not worship the financial genius. Seek only the perfection of the process, and the market will eventually reward your systematic approach. This has been the definitive audiobook summary and modern context analysis of Trend Following by Michael Koval. If you found lasting value in this breakdown, if it has changed the way you think about risk, emotion, and the true meaning of discipline, make sure to subscribe to Capitura and ring that notification bell. Because next time, we're unveiling another financial classic that can completely change your perception of market volatility and your path to lasting financial independence. We're going deeper, we're getting longer, and we're making sure you have the mental tools to profit from any market condition. Click the subscribe button and join us. We'll see you in the next one.